Hi there. This is Bob Graham with Riggs Asset Management Company. Well, we're about halfway through 2026, so I thought we'd do kind of a recap of what we've seen in the first half of the year and what we see as we move forward into the second half of 2026 and, quite frankly, into 2027. We started off, we thought 2026 was going to be a decent year for the markets. And, so far that's proved to be true. You look at your portfolios, Rick's family portfolios are doing very, very well in this market environment. And our expectation as we work through the year, it will continue to do so. Having said that, we think there's going to be some bumps in the road in front of us, just like you noticed there were some bumps in the road behind us. So, kind of recapping, going into this year, our expectation is we would follow sort of the midterm election year cycle. And, with some probably slightly higher volatility, that's essentially what we've done. We've had a decent start to the first part of the year. We had a pullback in the spring. That was largely due to the conflict between the United States and Iran in the Straits of Hormuz. And then, kind of a re-rally into the summer. That's pretty normal for a midterm election year. Our expectation as we get close to fall, as we get close to the election, we'll get another pullback in the market. That tends to be where you get the stronger pullbacks. We'll see how things evolve, but we're very, very cautious as we think about the fall of this year. And then we typically end the year very strong. Our expectation is, while we think that the ranges may be slightly higher, at least that's what we've seen so far this year, we think the pattern probably holds. It's been a good first half of the year, a little bumpy, and kind of like we were talking about last year. Again, the markets are kind of two steps forward, one step back, two steps forward. As we go through the summer, our expectation is the summer will be bumpy, but should generally be moving higher. That's true for both the stock market and I think the bond market now, which I'll talk to in a minute. Like I said, coming into the election, probably get a pullback. There's always a lot of political noise, a lot of headline risk around elections that tends to manifest itself in people's psychology and the markets. But once we're through that, we think the U.S. economy is on a really good footing. And so it should be a really good year end. Let's break it down. Let's talk about what we're seeing in the bond market, what we're seeing in the stock market, and how are we managing portfolios to take advantage of where we are. We saw interest rates spike as the conflict with Iran accelerated and the price of oil moved up, and therefore inflation moved up with it. But what we're really seeing, which is interesting, and we've seen this over, let's say, the last, call it month or so. So it's really mid-May into the end of June. And we've seen energy prices steadily come down even before the conflict came to an end. So we're going to put up a chart here you can see. And what we have on this chart is a comparison between West Texas Intermediate crude, one of the major global benchmarks for oil, and gasoline futures. That is the expected future price of what we will pay at the pump. And what we're seeing is they have both come down remarkably. Going into this, I thought we'd probably bottom out with crude oil prices around 80. Well, they're already below 70. So the decline in energy prices has been much more rapid than at least I originally expected. So that's a good thing for inflation. What does that mean? Well, it means that, right now the price of the pump, depending on your personal state tax situation, is below $4 a gallon. And, if everything stays the way it is, by the end of the summer, we should see gasoline prices below $3.50 a gallon, maybe even lower than that. So right now, from an inflation standpoint, the main driver, which was energy or oil, has really begun to diminish. We'll see how that plays out, but right now that's good for the bond market. It means there's less pressure on interest rates to move higher, and maybe we can get back to a bond market that begins to think about future rate cuts. We're not there yet, but certainly we're seeing a calming of the volatility in the bond market, and that's a good thing for the overall economy. To the stock market, first half of the year has been very good. It's been even better for the Riggs family portfolios. We think the summer is going to remain choppy. We're seeing some rotation in large cap technology. But having said that, we're seeing other areas pick up. So we look at financials, especially regional banks are doing very well. Healthcare, especially in the drug companies, drug discovery, the biotech, the growth areas of healthcare are doing very well. And then industrials are doing very well. So when we look at the broader markets, we're seeing the market's doing well. You take smaller size companies, mid-sized companies, or larger size companies. On average, all of their trends are positive. You look at the number of stocks above their 20-day, their 50-day, their 200-day. Again, the trends are on average all positive. So all in all, the backdrop is pretty good for stocks. And we think that while there's rotation in the markets, you've seen the changes we've been making to portfolios. We're taking advantage of that rotation, and your portfolios reflect that. We think the summer is going to be bumpy, but positive. We have concerns going into the election. And if we see some of those concerns begin to be reflected in the market, we'll take action to protect portfolios and then have a decent year end. If you'd asked me the same question a month ago or 2 months ago, answers would have been a little bit different because of what was going on. But right now, we see a bond market that is very, very slowly improving, or at least stabilizing. We see a stock market that is, in general, doing well, with most companies moving up in price, while some very large cap companies, very large cap technology companies, are under a little bit of pressure, but they've had tremendous runs over the last 2 years. And so a little bit of backing and filling, or just a breather probably makes sense at this stage of the market. And we're seeing other areas emerge, like we said, financials, healthcare, industrials. We're seeing improvement across the board in all of those major industries. So all in all, we think the stock market is in a pretty good place, and the U.S. economy continues to do well. So if oil prices stabilize or move down, that's a positive for inflation. Take pressure off the bond market. That should help the stock market. We're still in a midterm election year, so we're going to have the volatility around that. But outside of that issue, things are looking pretty good. Your portfolios are doing well. You're well structured for the environment we're in. We're watching what's going on in the market, and we're watching historical tendencies because we know they will probably begin to kick in the fall. And we'll make changes around those things. But right now, we remain positive. We think 2026 is going to be a very good year. And by the way, 2027 may be better based on some of the research we're looking at right now. Kind of historical trends plus what's happening in the economy. So as we work through this, what's going to be a choppy, a little bit more volatile year because of the midterm election, we're really thinking about setting up for where we're going to be 6 months, 12 months down the road. And we think right now, with what we see in the economy, what we see in the interest rate environment, and what we see in where the growth is coming in the markets, we think the outlook is really good. Anyway, if you have any questions about this video or any personal financial question or business financial question, reach out to your Riggs team member. We're here to help you and answer any questions you may have. Thank you very much.